we're going to jump into the in the money cover call, a deep in the money cover call.
Our channel. Happy trading. Manage risk.
And what we're going to do it on is Walmart. And I want to show you the chart of what Walmart has been doing. This thing has just been shooting up. So it's good that it's down right now for us, but you can see it's been shooting up. And we had a trade on, a collar trade on in Walmart on Friday or Thursday, and it expired in the money. So our shares were sold away, which was great. We want that to happen. And so now we're going to do a deep in the money covered call, and we're going to set it up in a way that our shares are going to be called away at a very high percentage, but we can lock in the price that we want. And so if we go here, let's go out 11 days. Would love to do the 4 day, but I don't think it would give it enough premium. But let's just check, right? So if we did this, we're going to look on TastyTrade first, but we're going to do it on Thinkorswim. So if we went here and let's say we sold this covered call in the money, and this is we're selling the 83 delta on the call side. And if we did this, we would get $40 after or before fees and commissions, $40 there. Okay, and the fees are going to be about 65 cents at the most. That's what most broker firms are doing. Tasty Trade, the fee will be 50 cents because you don't have to. It's no money to close, but they do charge $5 to get assigned. Thinkorswim doesn't charge anything if you're assigned. But what this is saying, everyone, is that if we can get filled, and I just say if we can get this $40 here, then this is how much we will get. We would get almost 88% of the time. We're not only going to win, but we're going to win the $40 that we're looking for. So let me show you what I mean here. If we go to this analysis here, and you can see that if it goes up, we're going to win that $40. If it goes down, and as long as it doesn't go down past the 146, we're still going to get that $40 if we can get filled at that $40, right? So to me, that's pretty awesome. So we'll look at that in a second. But now let's also look at the 11 DT. We're doing this in the short term. This is a dividend aristocrat. That means that Walmart has been around for at least 25 years, has been paying a dividend for at least 25 years, and they've been raising their dividend for at least 25 years straight. So we all heard of him. We all probably have all shopped at it before and so forth. This is definitely a staple. And when things start to go bad in the economy, Walmart shares or stock is going to do well, in my opinion, because it's like a safe haven. When people start to have to cut back on their expenses, Walmart is a good place to do that at. All right, so if we go here and we do this one in 11 days, and I just go out to another 83 delta. You can do a 90 delta, you can do a 95 delta. In this case, we would get $60 in the next 11 days, and we have a 90% chance of getting that $60 darn near, right? Very close to a 90% chance of getting the $60. So I like this trade. It's no upside with this one, right? You're either going to get that 60 or you're not, right? And then if we go over here to
Brian.
Yes.
Hi, it's Judy.
Go ahead.
Isn't that kind of a break even? I mean, you're buying the shares at 150, and you might get called away at 144, and all you're bringing in premium is 60. That seems like a break even. And if you had to pay fees, it'd be a little less. Am I looking at that wrong?
So you are selling the shares. You're saying you're willing to give your shares away at 144. Okay. It's currently trading, I just say, at 150, right? So someone's going to have to pay you at more than $6, right? Because 144 for 6 is 150, right? So that would be a break even, actually losing after fees and commissions. So you would have to receive more than $6 for this to be worthwhile for you, right? So now let's just say that you receive 660. You receive 660, so you're getting another $60, okay? And so if it expires anything above 144, then what will happen is that you would lose the $6 because it's going away, the six, but you would still get this 60 cents, which is $60, right? And that $60 is you got a darn near 90% chance, looking right here, to getting this $60, not just winning, but getting this $60.
Subscribe to our channel.
I was having some conversation with a member, and her questions helped me kind of see that I needed to articulate this deep in the money cover call a little better. And so what we're going to use is this Charles Schwab account here. And so what I want you to see here is that I'm going to go to 11 days, and we're also going to look at the 4 days to expiration. But what you want to understand with a deep in the money covered call is that you have what is called intrinsic value, and then you have what is called extrinsic value. Extrinsic value is time value. So when you're selling something out of the money, like something like this on the put side, this is all time value. It doesn't have any tangible or intrinsic value. It's only time value. So this 75 cents or the 77 cents here, this is all time value. If time expired right now, this would be worthless. It wouldn't have any value. But if we were doing something in the money, so for example, let's say we sold something in the money on this call side here. Well, if it expired right now, it would still have some tangible value, right? So for example, this is trading at 49. This is the 49 strike here. And it's currently trading at 52. Well, this right here is worth, let's just say $4 for easy math, right? So that $4 would take you up to 53, right? So this has at least $1 of time value, or in it. It still has $1 of time value plus the intrinsic value. So if you sold this call and it didn't go down, right, then you would be able to make that $1 if you were doing a cover call. So for example purposes, let's go and do that again. If we sell the cover call, now you're buying the 100 shares and at the same time selling the call. So if we go over here and we put this at the 49, you can see that this is saying we will be able to collect $110. That's how much extrinsic is in this, the time value that's in this 49 strike on the call side, right? If it expired right now, we would win $115 if we were able to get filled on this, and it was expiring right now. If this said 0 DTE, then we can make it that much if it stays above the 49. So that is the key here. When you're doing a deep in the money covered call, you want to be assigned. It's a bullish strategy. You want it to go up. Or if it goes down, you just don't want it to go down more than the strike you're selling the call at, and then you will win the entire amount that still has intrinsic value to it. So for example purposes, we go back to this curve view and we look at this in analysis here on TastyTrade, you can see that, and this is this box up here. I know it's hard for you guys to see, but if it stays above and keeps going up, you're going to win that 110 that it's now showing, 110 to 115 here. But if it goes down, you're still going to win all of that 110, 115, as long as it stays above the 49. This is a bullish strategy. As you can see, if it goes down too much, then that's where you start losing. Right? That's where you start losing. You still have risk all the way to zero here. This is not going to go to zero, but you still have risk all the way to zero, but it has to move a significant amount before you lose this amount and before you start losing. All right, so this is the 11 DTE type of setup. This would be nice if you can get filled. You might have to put these things in and kind of play with the amount you get filled, because this is deep in the money. Sometimes it's hard to get filled with these, so you might not get 115, you might get 110, or you might not get 110, you might get 105. That's all good for this trade for 11 days. This is really rich right now, and it's because Charles Schwab here it's been under a little pressure, just like some of the banks, right? This was deemed to have some risks of people removing too much of their money and Charles Schwab having a problem. I don't think that will be the case. They're way too big for the Fed and the U.S. government to allow this to fail. I'm gonna go over here. I'm gonna go to Thinkorswim, and what I'm gonna do is find 11 day, and then I'm going to, on Thinkorswim, what you can do is you can right mouse button click, and I think we were going on a 147. You right mouse button click, and you can go with buy, all in one trade, buy the covered stock, they call it. You can do this on TastyTrade as well. So this is called covered stock on Thinkorswim. So then you can see we're selling the 147 and we're buying the shares all at the same time. Okay. And then if I go here and I click on this, you can see that right here it's saying that our max profit is going to be $86, right? And it's jumping all around and it's not down that much more. But we're going to have a super high probability of being able to get this, that $86 in the next, and we're not going to get any upside. If it goes up, we're going to win that $86. If it goes down, we still have a very, very high probability of winning that $86. Okay? So we're going to send this, and we're going to see if we're going to get filled. It's these trades you got, it's in the money, the call, so it's going to be a second. It's not going to be like right away. Usually you're going to get filled. You have to let it play out a little bit. And so that's what we're doing here. We're saying 146.14. They're saying 146.15, right? So let's give it a second and see if we can get filled with this one, with the Walmart one, because it's an in the money one. It's a little harder. So what we're going to do is move it up another cent. We're bringing it up because that is the price, right? So we got it at 146.17. So there we go. And we'll see how it plays out. It's an 11-day trade. We are betting that it's going to go up or not go down more than the 147. And if it doesn't, we're going to win that monies that we're trying to collect. Okay. So there we go. I like the trade.